Hi guys, thanks for tuning in to another episode of Nuggets News. Today we've got a special guest, and that is Mark Moss from Market Disruptors. How you going, Mark?
Yeah, hey, I'm doing great. Thanks for having me on.
I'm really looking forward to having you on today to talk about the history of money and Wall Street and what Wall Street does to assets once we get them on there, because Bitcoin is about to step into that big Wall Street boxing ring, and there's all sorts of theories about how that's going to play out. We've already seen price go down since those futures launched in December. But just quickly, mate, what's your background, and why do you think this stuff is so important to talk about?
Yeah, it is super important to talk about. My background is I've been a professional investor for about 20 years, a lot of real estate, spent a lot of time in gold and silver with mines and miners and whatnot. I'm still invested into oil fields and things like that. So a lot of kind of commodities, what you may consider real world assets, not like currency. I'm also a student, so I'm a student of history. I think it's important to understand history to kind of predict the future. And I've been doing that. I've been involved in the cryptocurrency space for a couple of years now. Got in kind of early, and really it was just because of my investing. Really always looking for what I call non-traditional investments. So like 401ks and mutual funds were not like cutting it for me. So that's why I'm always looking into, non-traditional investments. And that's kind of how I heard about Bitcoin first. And really when I learned that it's so much more than just money, it's not like PayPal 2.0. There's a whole lot more going on, specifically with the way it's going to disrupt the way we communicate, our politics, the banking system, and all those things. That's what really drew me in, and so that's what I'm excited to talk about.
Yeah, let's start off with talking about the history of money. I think a lot of people are fascinated with all the documentaries about the GFC, but even before that, about money being on the gold standard, and then it's just a paper, not really backed by anything other than government confidence. So, what's your thoughts on all that?
Yeah, so I think it's first of all, I'd say that I'm really happy with the Bitcoin revolution, I guess we can call it that, because it's bringing all these people in, and what it's doing is getting this renewed interest into these topics like you're talking about. A couple of years ago, nobody wanted to talk about the history of money or what banks are all about, but today people are really interested. One thing is like fiat currency. You talked about in the intro, government money. That's fiat. But a couple of years ago, nobody knew what fiat currency was, and today it's a household name. So first off, I'm super excited to see that revolution kind of kicking things off. But I think as more people get interested, and they kind of start peeking behind the curtain, it's going to start opening their eyes, and they're just going to want to kind of go down that rabbit hole and learn more.
Yeah, I think that's exactly right in terms of people being labeled like gold bugs and conspiracy theorists, and the GFC happened but central banks fixed everything, and it's not. No, they haven't. They haven't fixed anything at all, and they're not gold bugs. These people are raising a valid point, and for the first time, as you say, through Bitcoin, people are starting to ask a lot of hard questions.
Yeah. And I think it's important. Sometimes we need to make sure we're looking at the whole picture. And I think if we're only looking at price, that's only really telling us part of the picture. And without understanding the whole picture, we can't really get what's going on. And you talked about gold bugs. And so that's kind of a good place to start. Gold has kind of been the best money, the most sound money we've had for quite a while. But lately the price hasn't gone anywhere. The price has kind of come down. It's been suppressed 1,200 to 1,300 USD for an ounce of gold, and it hasn't really done anything. And people are kind of forgetting about it, or so you might think. The average person is forgetting about it. But at the same time, we're seeing governments, sovereign governments like China, who's been accumulating more gold in the last decade than any other country in the world. We have countries coming over to the US asking for their gold back. They want to take it back. So we're seeing global governments very interested in gold, but the price is being suppressed. So the public is losing interest in it, but you got to look at the whole picture.
Oh, exactly right. I think you can definitely add Russia to those lists, and all the people
Yeah.
trying to move away from US dollar assets. And the fact is, as more countries and more of the population come into the sort of middle class and the industrial revolution, maybe the less relevant the US sort of becomes. And people are saying, well, why should they have that reserve status and get to print money and all those sort of things? So I love the fact that we can have those conversations.
Yeah, and it's interesting. Obviously you're down in Australia. I'm in the U.S. I'm usually talking to people from the U.S., of course, and I think we get this bias. We all have biases, right? But we have this bias based off of where we live, and so the people in the United States, they grow up thinking a certain way, and they don't maybe get why Bitcoin or why crypto or why privacy are important because we have a certain way of life here. But in other countries, they get it, right? They understand it.
100%. We spoke about that the other day in terms of Australia's the lucky country. We haven't had a recession in, I think it's 3 months away from the longest ever, and our housing market's in a 40-year bull market, and all these sort of things. And people, it's pretty hard to convince someone to get into crypto for all those fiat sort of history lessons. Whereas if you go to Venezuela and look at the local Bitcoin's volumes at record highs and hyperinflation, it's pretty easy to twist someone's arm and say, hey, don't use central bank money, use this instead.
Yeah, for sure. And I'm sure just like in the US, Australia is probably the same, where we've seen our money become inflated. And what that does is it lowers the purchasing value. So I know like in the United States, most people think that things have just gotten a lot more expensive. Like the average home, 50 years ago was 50,000 and today it's 300,000. But the reality is it's actually taking more dollars to buy the same thing. And we know that when we compare it against baskets of other commodities like oil, gold, et cetera. So it may take the same amount of barrels of oil or ounces of gold to buy the average home 50 years ago that it does today. It's the dollar values that have changed.
And even in terms of the Aussie dollar, when I first bought some silver a few years ago, the Aussie dollar was $1.10 to the US dollar, and now it's dropped all the way down to the 70s. So that has certainly shielded that fall in the price of silver in terms of my local currency, but even more so in those developing countries.
So the way it works with the history of money is we need something to use as a medium of exchange, MOE, we call that. But we also need somewhere to store our savings, right? So that's a store of value, an SOV. And the best SOV wins. The best store of value wins. If my store of value is better than yours, you're going to put your money where I put my money. The problem comes in where if whatever I'm storing my value in, if you can recreate it cheaper than I can, you can steal my wealth away. And that's what we're having with the dollars. I'm storing my value in dollars, but the government's creating them for less than I can get them for. And it's stealing my wealth away.
Yeah, and unless you understand exactly how that all works, then you don't understand that gradual erosion, I guess, that's happening in the background across generations and so on.
That's a perfect way that you put that, right? It's like that erosion. So you don't really see it happening today, but like your kids are going to be affected and your grandkids. And so a lot of times I think, especially in our society that we have today, everybody's like looking at today, looking at tomorrow, instant gratification. But investing it's a long-term gain, a game. I mean, I need to prepare for my future, my kids' future. And so it is important to understand these because before you know it, it's too late.
Exactly. Let's dive in and talk about how Wall Street got into the gold game and gold ETFs. And now we see futures and we read things like global annual production of silver shorted on the market in one day. And I know you've been very passionate about this topic. So how do you think that all plays into what we're seeing now and suppression and all that sort of thing?
Well, I think on one side of it, we can kind of look at gold and Bitcoin kind of being similar in a sense where they could both be a store of value. They're both property or commodities, so they're kind of the same type of asset being used the same way. So, gold's been around for a long time, so we can kind of see what's happened with that and maybe predict what's happening with Bitcoin. Like I said, the price of gold has been pretty much suppressed, but it's heavily manipulated. So stocks and cryptos are finding a true price every day on an exchange. There's buyers and sellers, and it's finding a price there. But gold, the price of gold is set every day in London. So it's a little bit different. In addition, we have Wall Street, as you just kind of led to. Wall Street has kind of got a hold of it, sank their teeth into it, and they've what we call financialized it. And what that means is they've turned it into a financial asset, and that puts a lot of downward pressure on the price.
So, how does rehypothecation work for someone that's watching at home that doesn't really understand derivatives and options and all that sort of thing? How would you explain that to them?
So what that is, before we get to that, so it's what Wall Street does. They financialize things. So they want to turn. There's two types of financial assets. Really simple. Two types. We have an equity-based asset and a debt-based asset. So if I own something like the Bitcoin that I own and I keep in my own wallet, in like my hardware wallet, that's an equity asset. I own that. If I had a piece of land that I owned outright, had no debt on it, that's an equity-based asset. But as soon as I get a loan against it, that loan now becomes an equity asset on someone else's balance sheet. So, for example, if you loaned me money and I owed you money on your balance sheet, you could say I owed you $1 million, even though you don't have it. And then what you could do is you use that $1 million as leverage to get another loan. And that now that debt becomes an asset on someone else's balance sheet. And that's called hypothecation. And when it's done over and over and over, it's called rehypothecation. And eventually that debt could be added to 5 people's balance sheets, 10 people's balance sheets, but there's only one debt. And so it's like if I loaned you a chocolate bar and you owed me a chocolate bar now, that's one chocolate bar. But now you could loan that chocolate bar to someone else that owes it to you, to someone else, to someone else. Now there's 5 people that are owed a chocolate bar, but there's only one available. And so that's kind of what we're talking about. And that's what they've done with gold. And that's what they're trying to do with Bitcoin.
Yeah, and it's slightly different to fractional reserve banking, but it's the same concept, guys, that this is the basis of a lot of parts of the financial system now where you can lend out and only keep a very small fraction in reserve, and then they can lend out that loan to that bank, and it goes around and around. And if anyone actually ever calls in these loans or says, I want that back, that money, or in your case, I want that chocolate bar back, and there's 5 people that have it as an asset they own on their books, but there's only one in real life, that's where we see things like the financial crisis and whatever.
Yeah, and if I called that chocolate bar due, you could go get it from the other guy. He can get it from the other guy. He can get it and eventually it could make its way back to me, maybe. But that would take a long time. But in financial instruments like Bitcoin, for example, I may not have that amount of time. I might need it like today, and there's just no way to do that. But you mentioned like fractional reserve banking, right? So if I put $10 in my bank, they're loaning out 9. Problem is they loan those 9 to you, and what do you do with them? You put them in your bank, and then they loan them out 90% again. And then what does that person do? Back in the bank. And so it kind of creates that money. The problem that I see with that is, if it's happening to gold, if it's happening to dollars, those are kind of like static assets. But Bitcoin is a technology, and it changes and it evolves. We can have forks. Value can move from one chain to the next, and it changes the entire dynamic of what the financial system is used to.
That's a pretty interesting situation. And I know back in the day when there was the first ever Ethereum hard fork, that a lot of people that were borrowing on margin, they were the ones that got the hard fork, and the people that own the Ethereum that had lent it out said, hold on, why don't we get Ethereum Classic, it was at the time. We own those coins. And then they said, well, no, you've loaned them to someone else. And that's probably a really simple example of who owns what and who gets that hard fork. And that's going to confuse people on Wall Street if there's all these ongoing Bitcoin forks and all that sort of thing as well. So, yeah.
Yeah, that's a great example. And so we like to say with crypto, like if you don't have your keys, you don't have your coins.
100%.
And so even if I had my Bitcoin on Coinbase last August when they forked into Bitcoin Cash, you didn't get that, right? So it happens all the time. But what happens if now we have 5 people or 10 people that have a claim to one Bitcoin, and then you have that fork, then what happens? Who gets those fork coins? Where do they come from? But what's even worse is if we had an example where the coin forked, kind of like Ethereum, but all the value moved to the new chain. So they're stuck holding the existing Bitcoin, but it's worthless. And now all the money moved and nobody got that. Yeah. So that could create a massive problem. In the financial markets, like we're talking hundreds of millions, billions of dollars, like I need that like today. Like I can't get those billions of dollars like 2 weeks from now or 2 months from now. So it's a whole different animal.
Yeah, I mean, I want to pivot a little bit because I remember reading about circuit breakers on the stock market a couple of years ago, and it was, again, these are articles that are on places like Zero Hedge, and people say that's all conspiracy theory. And they're saying, if markets fall 7%, then the stock market sort of closes, and if it falls another 5%, it closes for the day. And that's not a free market. They're just saying we're going to prevent markets from falling further and further carnage. Now, only a year or two after that happened was the Trump election day, and I clearly remember watching the markets that day, and the circuit breakers got hit a couple of times for commodities like gold and the stock market. And something we spoke about the other day in the pre-interview was what happens in the world of Bitcoin that trades 24 hours a day, 7 days a week. If we've got ETFs and derivatives, then what happens if Bitcoin moves 70% over a weekend, and all these people that are trading on margin on Wall Street, it just doesn't fit their model of circuit breakers. And do you agree with that?
Yeah, for sure. So what we call that, you kind of hinted to that, where you talked about fractional reserve banking. And there's not enough dollars. And really, if like 1% of the people lost faith and said, you know what, I don't know if the bank's gonna have my money, I want my money today, it would actually, we call that a run on the bank, and it could actually crash the banks. But what the banks have, what the stocks have, is they have what we call a lender of last resort. So if that were to happen, then the Federal Reserve steps in and prints more money. If it happens in stocks, the DCT steps in. And so you have this lender of last resort. But with Bitcoin or cryptos, there is no lender of last resort. Like it's a game of responsibility, right? Where we have to be responsible for ourselves, and we don't have anybody to bail us out if that happens.
The current products we have now is a basic futures contracts that basically track the price of Bitcoin, and there's always two people on either side of that contract, guys. There's a buyer and a seller at a given price. Now, what Backed have come out and said today is that their first product is going to be that Bitcoin actually physically backed. So for each contract, it's going to actually represent one Bitcoin they have to buy. Is that things that you say that's okay? I don't really mind that sort of product versus these ETFs that are just then tracking the futures price. They don't own any Bitcoin. Again, as you say, there's nothing really underlying that asset.
Well, I would say they're better, right? So basically what we have is we have what we call physically settled or spot settled. So that means if it's spot settled, they're not actually buying the asset. So I'm going to bet you that Bitcoin hits $7,000 next month, and you're going to bet me it doesn't. But whoever wins, I'm just going to pay you in dollars, in cash, fiat. So we're never actually buying Bitcoin. We're just making a wager on the side of what we think it's going to do. That's what futures do. So talking about like an ETF or what BAC wants to do, the CBOE Van Eck ETF also was talking about being physically backed. So they would actually buy the Bitcoin as opposed to just betting against it. So I do like that better because very simple. We have supply and demand. We have demand. If they remove coins out of the supply and the demand still there, the price goes up very simply. So I do like that. But here's the problem. Now they're holding the Bitcoins on your behalf. That means you don't have your Bitcoins. They're owed to you. They're owed to you. Now they've created a debt-based asset on that Bitcoin. Now they can loan that Bitcoin or let that debt become an asset on someone else's balance sheet. So if they would say, hey, we're only going to sell it 1-to-1 ratio, it's not going to be a debt-based asset, we'll keep it in a special account for you, then I like that. But I don't think that's going to be the case given their track record.
Yeah. And the two reasons that I don't like debt-based instruments, guys, the most easy way to explain this, I guess, is if there's people with deep pockets that want to buy Bitcoin and they want to put in $100 million into this ETF, if it's not buying real Bitcoins, it's not pushing up the price. It's just going into the pockets of some custodian and that debt-based instrument. And it's the same on the flip side. If there's people that want to see the price suppressed, they've got deep pockets with fiat money that's been printed by the Federal Reserve and lent to them and whatever, they can continually just drive the price down without actually selling real Bitcoin. So that's the frustrating things, and you can put your tinfoil hat on as to why that happens or how much it happens, I guess. But do you agree with that, Mark?
Yeah, you're absolutely right with that. That is the problem. And again, it goes back to the supply and demand. So if that money was going into Bitcoin, it would bring the price up. But instead of it going into Bitcoin, now it's going into a paper version of Bitcoin. And we've seen that in gold, right? You asked about gold. So it's estimated that there's 500 ounces of paper gold for every 1 ounce of physical gold. So if that paper gold wasn't available and all that money were to move into physical gold, it'd be 500 times higher in value, theoretically.
Yeah.
Theoretically. So, it's bad for a whole lot of reasons.
I think that fact alone shows you how distorted the financial system and fiat debt-based money has got from real-world assets. When something is, I think silver market's even worse in terms of the size of the actual physical market versus how much money. And at that point back in 71 with Bretton Woods and whatnot, they said, look, this just doesn't work. We're printing too much money. It just does my head in how it's so simple, something like that. A fact you say, yet people just say, oh, this is normal. This is how money works now.
And I think we can accept that this is just how it works and it seems to be working okay. And I can just kind of keep my head in the sand and work my 9 to 5. But if you ever want to get ahead in life, you really have to understand these things because it's going to have a massive impact in the near future, in our lifetimes, for sure.
Yeah, it works.
And you said, Bretton Woods Agreement. So this all really shifted in 1971. So not that long ago. Whatever, 40 some years ago. And we've gone so far, so fast. In 40 years, we've basically come up with about $200 trillion of debt globally, 200 trillion in 40 years. And so it just can't go on much longer. And so it's important to keep your eye on that.
Yeah, it works until it doesn't. And the fact is that on a finite planet with finite resources and all these other countries coming into the fold and wanting buildings and iron ore, gold, silver for technology, whatever it is, it works into the point where it doesn't work anymore. And that, who knows when that is, but be prepared. And if you understand all these things, you're going to come out better on the other side.
Yeah, definitely.
I think that's a good place to end. Unless you've got any other thoughts, Mark, where can people follow your work and all that sort of thing?
I do want to add just one more thing, and not to be a fearmonger, but the way it gets even worse is there's one more word, which is what Wall Street does, which is commingling. And we know, like in 2008, we saw the entire banking system of the whole world basically kind of come down together because all these banks are investing in each other's assets. So when one bank goes down, well, this bank owns a bunch of that stock, so it goes down as well. And what they do is they commingle. So when they're holding your Bitcoin, they're going to hold those in an account with all their other assets, their cash, their securities, and whatever. And if we see something happen with a hard fork or something, they lose value, now it puts the entire system at risk. So that's a fear that we have. There's some smart people that have just been this week talking to Wall Street, talking to the SEC, warning them about these types of things. Hopefully they'll be smart enough to take those warnings. But in any case, it's bad for the current financial system, but it's good for Bitcoin. Bitcoin is that hard sound money that we need. So I'm optimistic on that, not to end on a bad note.
No. I was going to say, guys, I think people are going to like this. Maybe there's part 2 coming up. We can dive into real estate and other things as well. So thanks so much for joining us today, Mark. And where can people follow your work?
Yeah, so I did a pretty deep 4-part series on this topic. So if you want to learn more about this, go to YouTube, just search Market Disruptors on YouTube. You can find that 4-part series. And then you can follow me on Twitter at @1 Mark Moss, @1 Mark Moss. And I put a lot of stuff out every day kind of about this as well. So follow me there.
Awesome. I'll put the links in the description, guys. Thanks for joining us again, Mark.
Yeah, thanks so much.
Cheers, guys.